Good afternoon. My name is Hussein Zaidi. I'm the Global Head of Bond Syndicate for Standard Chartered Bank. So the next panel, which we're going to have, is going to be focused on the DCM markets. And specifically, we're trying to touch upon certain aspects of the DCM market, which are very close to our heart at Standard Chartered. But I think more importantly, talk about the trends that are happening in the market. And I think in that regard, we have a very esteemed panel, a very diverse panel from an industry perspective. It's probably the most diverse panel I've been on, where we've got issuers and investors from different sectors. So I think what we try to do is drive straight into the panel. We have 40 minutes. I think the last 5 minutes we'll spend on question and answers, and then we'll go straight to the conversation at this point in time. I don't think I will do justice to the introduction of my fellow panelists. So what I'm going to do is maybe ask them to introduce themselves, spend a minute on their respective institutions, and then when we start the conversation from there. So Arturo, please.
Sure. Well, thank you very much, Hussein. Thank you very much, Standard Chartered, for the invitation to this panel. My name is Arturo Seco. I work at the Council of Europe Development Bank, where I'm Deputy CFO, Head of Funding, Treasury, and the ELM. So the institution itself, Council of Europe Development Bank, is a supranational institution. So we are an issuer within the SSA sector. Created in 1956. We have 43 member countries, with Ukraine being the last member to join. And very important, we have a single objective, which is social cohesion. And as you can imagine, in the last few years, with the last few crises, we've been very demanded in terms of disbursements of the loan activity, first with COVID, then with the Ukraine conflict. And what is important also is to know that we do not receive contributions from the member states. What we have is shareholders, so they have part of the capital, but all the most of the balance sheet is funded by debt, so by our issuance in the capital markets, international capital markets, through benchmark transactions, but also in different currencies. Maybe just one word on the capital itself. Because of the needs that we have been, they have been increasing over the time. In the last 5-6 years, I would say, a capital increase is on its way as of now, and that will create a buffer of capital, which is essential for an institution to keep our activities from now on.
Thank you. Thank you for coming.
I'm Omotunde Lawal, and thank you, Hussein and Standard Chartered, for having me. I run the EM corporate debt as well as the EMEA corporate credit business at Barings. Barings is an asset manager owned by Mass Mutual Insurance.
Great, thank you.
Pierre-Frédéric Rémy. I'm the Chief Financing and Treasury Officer of LVMH. Thank you very much also for the invitation. I'm pretty sure you all know LVMH. If not, I invite you to test our great wines and champagnes, or visit our stores close to the Avenue Montaigne. But anyway, we are not such a frequent issuer, but maybe we've changed a little bit over the time. Previously, we were probably a bit more event-driven, but recently, with the stock that we have accumulated in the debt capital markets, we tend to refinance a bit more or outstanding stock.
Thank you for coming.
Hussein. So Patrick Dupont-Léaut, I work in the corporate DCM business based in London, covering a whole host of European corporates. So delighted to be here. Thank you.
Thank you. And I think one of the key topics of conversation from a Standard Chartered perspective is, I think 2024 for us has been a very important year from a DCM perspective, especially in Europe. Caroline, thank you for your efforts in that regard. And I think one of the conversations is we've obviously seen the bond markets extremely active this year, both on the US investment grade side and the European investment grade side. I think the beauty of the panel today is the fact that we have Arturo, who's recently done a US dollar bond issuance, Pierre-Frédéric, who's recently done a very successful euro transaction. Of course, Omotunde is part of the markets all the time. So it'll be great to get their perspectives on where we are with the bond markets currently. As I said, it's been a record start in terms of issuance volumes. On the US investment grade side, we've had $850 billion of issuances year to date. On the euro corporate side, it's been around 250 billion euros. Interest rate cycle seems to be at a stage where there is more liquidity coming into credits. both on investment grade, emerging market side. We've obviously seen a lot of inflows into this asset class, and the redemption cycle is very positive. So from an issuance perspective, it seems to be conducive, but this is where I wanted to get a perspective from our fellow panelists on their views, and then we'll dive into the other topic of conversation, which is the diversification of the investor base. So Arturo, maybe we'll start with you. You've recently done a very successful social inclusion bond, $1 billion US, 3 years, and I read that it was the tightest, one of the tightest spreads over US Treasuries on a swapped-in basis ever achieved, single digits. So many congratulations. I think you've done 5 out of your $6 billion of issuances this year. So clearly, you've front-loaded your issuances. So just some perspective, how you found the markets in your recent, I think it was a June transaction, so literally last week. Mm-hmm. How did you find the markets, your perspective, given you are a frequent issuer, and why the front-loading of issuances this year?
Mm-hmm. Absolutely, no, that's a very wide question. But yeah, in terms of what was your perspective for front loading, it's, well, of course, geographical, geopolitical situation. 2 very important conflicts going on, Ukraine and Gaza. We have an electoral year, as it was mentioned in the previous panel. We have elections now unexpected also here in France, US elections, of course. And all in all, from last year, we decided that in the strategy of the funding plan was to go to the market quite early, mm-hmm. to avoid these peaks of uncertainty and volatility. And hand in hand with the issuance activity goes the investment activity. As investors, we have also been quite reactive in the first part of the year, as many of the investors in the market. But that's what it created, the willingness for front loading, the market context and the geopolitical context. So out of that, we have done 4 benchmark transactions so far this year, 2 in euros, 2 in dollars, 2 in social inclusion bonds, 2 in regular benchmarks. When talking about social inclusion bonds, these are issues where the net proceeds they are ring-fenced for specific projects which are eligible under the ISCMA framework. And all of them, they've been quite well received by the investor community. We have given extra liquidity to those lines because we increased the benchmark size at issuance, but we've been always been unwilling to also reopening the lines to have more liquidity and to attract further investor interest. And it was exactly the case in the last transaction that you mentioned, the 3-year dollar transaction, where we have seen books which were really oversubscribed, interest from investors which is still there, liquidity which is still there. I would say that investors, they are really very keen to participate in solid books, of course, but also in credits which are robust. And that was what we had, as a result of the last transaction, where geographical diversification was high, where investor type was also very diversified, not only central banks giving orders to the transaction, but also banks and fund managers. And we see, all in all, an appetite of the investor community for bonds which are reliable as of today. And I would say that this may continue for a few weeks, but I would presume that it may slow down a little bit, or quite a lot actually, in the market period, and to be seen what is the result of the different elections and the political situation, to see what is the market conditions after the summer. But in any case, we wouldn't want to have the risk of having too much funding to be done after the summer, and we are at the area of 85% of our funding done so far.
Congratulations. Great. Today, I think would love your perspective on the market. Arturo is of the view that we should front-load issuances, given the geopolitics which are going on. From an investor's perspective, do you prefer issuers front-loading the calendar? I mean, your views on the market itself, and are you going to be potentially as active in the second half of the year as you may have been in the first half?
So we have seen issuers front-loading first half of this year. In between all the treasury volatility, there are days where you do get some of the issuers coming through and sort of picking good days. From our perspective, I think everyone is somewhat cautious about second half, especially as we go into US elections. That's the big sort of bogey that everyone's watching out for. And so from that perspective, when we think about people putting cash to work, we see coming off of 2 years of volatility, especially sort of in the EM space, coming from 2 years of vol, we've sort of had a bit more stability. Some of the elections are sort of coming out of the way. A lot of those issuers are taking the advantage that actually sort of lock in their yields now, the sort of all-in yields that they can get now. They probably believe that they're much better than they can get second half of the year, so they're front-loading it. From our perspective, it's also good because we can actually put cash to work again. Last year, gross supply that we had in EM was just around the 300 billion mark versus, say, 500 billion sort of prior years before that. So there'd been a dearth of new issuance. And so for us, it was quite nice that the issuers felt first half they could front load, we could then put cash to work. And we've seen spreads really grind tighter as all that cash is being put to work. And we're also getting higher cash flows coming through from higher coupons. Although we're seeing redemptions at the asset class level, the higher cash flows coming in, the negative net supply has meant that actually as the issuers are front loading, there is enough demand to really meet that supply.
The technical picture is...
So the technical picture has been very good, and I was joking with a colleague earlier and saying actually probably need to close the book early this year around October and just sit around and watch what happens with the US elections and sort of the inevitable volatility that's going to come with that.
So I guess, Arturo, with your 85% of funding done for the first half, so far this year, it goes hand in hand with what Omotunde is saying as well. It's interesting. Frederic, very successful transaction very recently in the euro market this time as opposed to dollar market, dual tranche issuance, negligible new issuance concessions, if at all. You did mention you're not a frequent issuer in the market, more event-driven, if you like. What was your take on the market when you came recently? Maybe if you could expand a little bit on your transaction, which we were lucky at Standard Chartered to be involved in that trade. Thank you very much. But just your perception on the transaction, did it meet your objectives, both from a pricing, investor diversification, size perspective? Did it not? How would you analyze the trade?
Yeah, sure. Thank you for the question. First, so we have accumulated a little bit of debt, fully sustainable for us, given the size of the group. We have around, just to give you some rough figures, we have around 22 billion of external debt, of gross debt. Almost half of it is short-term and half of it is long-term. We mostly rely on the cash flows, the natural cash flow generation of the group. Having said that, we just need to be a little bit cautious from time to time. So the idea of the initial idea, the rationale of the transaction was just to rebalance a little bit between very short term. We mostly rely on commercial papers, including US commercial papers, and I guess we come back to that a bit later when talking about diversification. So actually last year in 2023, when the ECB was still in the phase of rising their rates, we decided to crystallize with a short-term transaction, 2 years and a half, some levels, because we knew that the cost of our short-term debt would still increase. And we had the feeling that, okay, we could make a little arbitrage, and we were, I think, successful, and we were a bit doubtful about the market, which was anticipating for us too much the drop of the rates. Right. It sounded to us a bit insane that both the Fed and the ECB would start cutting their rates while they were not even at the top of their rising cycle. This year it was almost the other way around. We knew that the ECB was about to cut their rates. Everyone is trying to bet on when the Fed is going to cut their rates. I don't want to be too painful with some analysts, but at the beginning of the year it was for the following week, and finally we can hear some banks saying that maybe in 2025. So let's see. But the point is, we wanted to upfront all needs. As you mentioned, there is a high uncertainty on the market. And then the decision was a bit easier with the fact that the cost of carry today is a profit for us. Basically, we could issue with at 6 years with 3 3/4 as coupon and 3.5 at 10 years, while basically we can issue debt, short-term debt at Esther, to make it simple. So actually it's easy to say, okay, let's take the decision a little bit in advance. And then one of the outcome of the transaction was also that I do believe it's a very basic and simple principle, but as an issuer, when you decide or when you think that you have to consider an issuance in the coming, let's say, semester, in the next 6 months, the value or the interest of waiting is quite thin, because there is obviously the market can be better, but if you believe that the market is good, you never know what can happen. And typically we knew that there would be the ECB, but we knew there would be the European elections. But honestly, I did not have in mind what has been happening since Sunday, which is just amazing and quite insane. So that's the kind of asymmetry that, as head of Treasury and Financing, I want to avoid to face. So the decision was not so complicated. When we issued, the market was good, but it could have been better. The rates were a little bit against us, but again, the thing is, we have seen so much volatility in the rate market, in the rate environment. Every single bip in inflation or in CPI or in market sentiment index has such a big impact on interest rates that I do believe it's worth going fast when you think that it's the right time to move. And then, given our credit rating, it's not so complicated for us to accept markets. It's an easy decision, and it's then between the decision and when we go to the market, and Patrick can witness that there is not so much time.
No, excellent. And I guess in hindsight, it looks like a very good transaction given all that you mentioned right now. Congratulations on that. Patrick, Frédéric, what are you hearing from your clients in terms of if they haven't come to the market so far this year, if they have funding needs end of this year, potentially first half of next year? How are they thinking about the markets from the point of view of interest rates, from the point of view of geopolitics, as we've clearly heard from Omatunde's views around investors thinking, let's take the chips off the table in the second half of the year. Are issuers also of that opinion, or do they prefer to, a bit like what Frédéric said, the trade's there, we went out and we did it. What's your perspective? What's your feeling?
So it's a very good question. I think a lot of issuers had about a decade where the cost of funding kept going in one direction. And as a DCM banker, it was always embarrassing to go in and tell the client you should go. Issuer, better view, didn't go. Next meeting, cost of funding's gone down. But I think when, obviously, Ukraine kicked off, and obviously inflation became a concern, we had abrupt adjustment in the marketplace. And a lot of treasurers hadn't gone through that, right? It was something fairly new. But it was so violent that a lot of people couldn't access the market, right? So for the first time, a lot of European corporate treasurers struggling to find the right window, struggling with the concept of having to pay new issue premiums that were in the context of 10, 15, 20 basis points. And so the treasurers were struggling with that, and the board was struggling with that. So we had a lot of clients who wanted to go, but they knew that the board hadn't yet readjusted itself in terms of the new coupon levels that were on offer. And so I think for the last year and a half, there's been now an adjustment. Obviously, last year was fairly volatile, but we had a perfect window in January, a bit like we had last year when investors had been burnt and they thought the window's there, we're going to take that window. The buy side thinking rate cuts are coming, so we're going to lock in the current coupons. And obviously last year those cuts never happened, and we saw the same dynamic again this year. But that's gone on for a little longer because there's more clarity around that it feels like we've hit that top, but the 6 cuts that were anticipated in January, they haven't happened, and it's questionable whether we'll have any cuts at all this year. But the market's behaved very, very constructively, and this year we've had 71 weeks of inflows out of 72 into the investment grade asset class. And so everyone right now is looking at this window and saying, we've accept the new coupon levels. We know we're not going to issue at the coupons that we were issuing 2-3 years ago. That's out the window. The boards have accepted that. The market's accepted that. And people also realize that this window can close very quickly, right? That's not been forgotten. So that's led to a very constructive first 5-6 months of the year where the buy side flush with cash, looking to put it to work, and treasurers also looking to avoid the second half of the year because of the volatility, the risks, right? We've been constantly reminded, again, the weekend events in France, that an unexpected event could happen, this could close. And so the key word I think a lot of people have adopted is being de-risking. So the mindset that a lot of issuers have had is, if I need to get something done this year, I might as well get most of it done before the summer. Happy to maybe leave something for the second half of the year. I'll average that cost in the event rates come down. But if I'm also happy to wait until next year, I'll be opportunistic and then I'll look for the January window, right? But there's been a mind shift in a market that's been very, very constructive.
And you think second half of the year is going to be a bit slower than what the first half have been, given your conversations?
Absolutely. I think most people have de-risked a lot of their funding. This year, in all my conversations with issuers all over the place, there's only been one treasury team that thought that maybe the second half of the year would be immune to events in the US, but everyone else has been a little bit more pragmatic. Spreads are at or close to all-time tights, right? So if you're looking at this from that perspective, it's very hard to say no. And obviously coupon levels are higher. Those cuts haven't come. People have to refinance. And so this is a very conducive market. And also new issue premiums, right? They are very, very low. I mean, we've had one issuer who decided not to go to market because they didn't feel they could get a zero new issue premium, right? And that is, it tells you how strong the market is and how issuers are thinking about the market. But that's very dangerous, right? I'm not a big believer in waiting for that zero new issue premium timing because that is not the norm.
Yeah. I mean, it's interesting, Patrick mentioned that this morning we had a call on a transaction potentially to proceed. And the issuer wanted a 8 out of 10 market to go ahead, and they decided to hold back despite the fact that the markets are reasonably conducive. So, it's to be seen. Hindsight is 20/20, but clearly the market is there. Seems issuers and investors are focused on that. So I think that's great. It's good to talk about the market, but also the other aspect which you want to focus on a little bit, Artur, and this is where I want to bring you in, is investor diversification. Your first trade this year in January, again, very successful. I saw the statistics on that trade, 26% into Asia, 12% on your most recent transaction, 20% on $2.5 billion of issuances on the dollar side. I'm focusing a little bit more on dollars and euros because I think dollars probably lends itself a little bit more to that diversification story from your perspective. But what is is that something you're seeing? And we've also obviously seen you look at private placements in different currencies, which are not euros, not dollars, Hong Kong dollars, for example. Just your perspective on how has the investor base evolved over the years, and how do you see it recently?
Well, this diversification aspect for us is a key aspect. To say that in recent years, well, we are coming from a period which, when between 2005 and 2021, roughly, there was not much diversification in terms of currency because there was not much demand from investors. We're coming from a period of multiple crises. We had the Lehman crisis at the time. We had the sovereign crisis in Europe. Then we had COVID in 19, 20, 21 were difficult years. And investors that were very risk adverse, only looking for a specific euro-dollar foreign name for the SSA sector transaction. So not big opportunities in terms of diversification. All that changed with coupons going higher, with the situation that was just mentioned, with the Ukraine situation having inflation at the highest levels historically. And that created also somehow an appetite for investors in order to diversify in currencies because they could find specific currencies where absolute yield was higher. Yep. And also spreads in some occasions were higher. So we saw this trend of geographically diversification was not possible in previous year. It started to be possible. Very true in Asia. So Asia, we have seen a lot of diversification in the last 4 or 5 years, not only for benchmark transactions, but also for smaller currencies, as the CNH, as Hong Kong dollar, for instance. Or historical presence in Asia in terms of investors was the central banks and official institutions. Mm-hmm. But for specific currencies, we see more and more of banking investors, fund managers. Also for the benchmarks, we start to see this category of investors, so a huge distribution. My question here would be, talking about interest rate cuts that were mentioned before, we all agree that last year the cuts were anticipated earlier in 2024, was not the case. That created front loading from many issues, but also investors, they were having absolute values which were and spreads which were reasonable, and fostered this issuance wave in the first half of 2024. Is this going to be replicated somehow in 2025? Because as the year goes by, we will start the second half with much less volume. We will start the second half with not as many cuts as we expected in euros and dollars. We will see strategies from issuers and investors at the last quarter being built, in the sense that better to take advantage of high yields at the beginning of 2025 and then foster this issuance wave. That's the question for me as of now. And let's see if that will create also this diversification perspective that we all search.
What's your view, Tunde?
I would say that you're definitely going to see more diversification, especially European investment grade. I think one of the reasons why I'm also here today is because we're seeing a lot more of the traditional emerging market issuer or emerging market asset allocators are looking for other places to allocate to. One, from a diversification perspective of maybe it's time to sort of spread out the risk a bit more, coming off of 2 to 3 years of quite a lot of volatility within emerging markets. But also because you don't really need to sort of reach that far into other risk assets to get the kind of coupons, the higher coupons that you guys are talking about. The markets reprice in Europe and US. And so you could stay within investment grade and still allocate to other asset classes and still get your sort of mid to high single digit type sort of carry that these sort of allocators are looking for. And that's part of the reason why we're starting to see a bit more of a push into European investment grade from my team, where we're starting to look at those kind of issuers where investors and asset allocators in the Middle East and in Asia, who would previously be your go-to EM allocators, are looking at European investment grade as a place to allocate to. So yes, you are going to naturally get that diversification of investor base come through from that as well.
And Europe for you, from a Barings perspective, obviously huge investor in the fixed income market, 400 odd billion under management. You've obviously very successful in the US as a US IG issuer, very successful in emerging markets with your team on the EM side. But the European IG, why? I mean, obviously, I suppose it's the part which was missing from a global perspective. Is the European investment grade, is it effectively focusing purely as a separate fund on that, or is it a part of a broader global fund which Barings is thinking about this?
It's going to be a bit of both. So Barings obviously is a full service asset manager. We've got public assets, private assets. We do investment grade, high yield, structured products, the whole remit. And I think that the investment grade business is a global business, but it was quite US centric previously. And now as we're getting allocators and investors wanting a broader sort of option menu, as it were, it was sort of the right time to sort of push out the European investment grade platform a bit more. So it's more fleshing it out. It did exist previously, but more fleshing it out better. And in terms of sort of why now, there's also changes happening in the European insurance landscape as well. There's bulk annuities, all the regulations changing around that, where a lot of the European insurance companies and the pension funds probably have more need for European investment grade assets to allocate to. And I think it's just timely as well.
Okay, best of luck for that. Thanks. And Frederic, I mean, if on LVMH's most recent transaction, I mean, clearly you said you're not a regular issuer in the Euro market, in the markets generally, and quite frankly, given the demand which we've seen for LVMH, the Euro market is sufficient. Investor diversification may not be a huge focus for you, given the amount you issue and the amount of demand there is in the Euro market. But is that I mean, we did see, given Stan Chart's involvement in your transaction, we did see a couple of Asian accounts come into the trade. In fact, in your shorter tranche, one of the biggest investors in the book was an Asian investor. How do you look at diversification from your perspective? I mean, are you more focused purely on the Euro market, or will be going forward? Do you consider different currencies? What's the reason behind considering them if you do?
Sure. First, clearly, we are quite opportunistic and I would say pragmatic. So it's a combination of different factors. you may think that diversification is not so relevant. We are AA3, AA minus rated, so it's clear that there is appetite for our credit, and also given the fact that even if I mentioned 22 billion, sorry, of debt, there might be half of it on the EMTN program. It's fully sustainable. Having said that, okay, we are a very strong company, a very strong rating, but I mean, you never know. When everything flies, when everything is okay, you do not need so many help from investors. But the day the market is more complicated, the day, I don't know, today everything is fine, but in 5 years, in 10 years. So I think it's always good to be a little bit cautious, and maybe it's because I'm the treasurer, so I have to be a bit cautious, but you never know, and it can make a little bit of difference. And also, the day that we come back to event-driven transactions, and the last large transaction we did was the Tiffany acquisition in 2021. It was a $16 billion transaction. Then it weighed a little bit on the appetite on investors. So it does make sense for us to look at different markets. You're right to say that we only had the the MTN program for the long-term debt, but keep in mind that we also rely a lot on the US market through USCP. And given we are very cash generative, we are able to rely on this market, but we have some seasonality in our cash flow generation, and also first, because of the business, H2 is much more cash generative than H1 in the luxury industry. And second, we also have 2 installments of dividends, and the bulk of it is paid in April. So H1 is always a bit trickier in terms of cash for us. So it does make sense for us to rely on these short-term US CPs. And it brings some natural diversifications. You're right, pointed the question of the diversification in our last issuance, and it was interesting to see that the biggest order we got came from Asia, and I'd like just to precise the fact that we received many feedbacks from Japanese investors saying that, okay, we were a bit too tight, but it was funny to see that, okay, the brand LVMH is known, Louis Vuitton, Moet Hennessy, but then when it comes to the details of the credit, there might be some confusions, and we are not so used to dealing with credit roadshows, and I received plenty of comments like, oh, you know what, Gucci is not trading so well, and then there is, oh, China is not so good. Well, and for the first time, I had to reply to some investors, recall them that Gucci is not part of LVMH Group, and it's okay. It's a great brand, but it's a different story. And even talking about China, I had to remind people that for LVMH, there's a bit of difference between mainland China and our Chinese client base, which are 2 very different concepts. So all of that to say, and interestingly, in the past months, we had some discussions with one of the biggest Japanese investors, and so we took some time to tell them a little bit our story, our strategy, and digging a little bit into the details. And finally, this investor put the biggest order in the book. So it does make sense to keep a link, even for us. Even if everyone thinks that, okay, we are very well known, it does bring much value when it comes to a live trade. And the day we come back again to a larger scale transaction, I do believe it will make sense.
Makes sense, yeah. So clearly, from what Patrick is saying, doing some investor work ahead of your transaction, especially when it comes to diversification, is important. I mean, you were recently in Asia, and in fact, I think you were on the flight from Dubai to Paris. That's so right. You've been to your efforts in terms of bringing different investors to issuers from Europe, investment grade market, is it paying dividends? Is it not? What have been your takeaways on your recent travels?
Yeah, no, absolutely. I think it's the diversification play. I think is absolutely for real. And I think if we look at what's gone on in Asia over the last 3 years, at least from the buy side, where G3 supply has collapsed. Literally, last year was a third of what it was 3 years ago, and we actually have net outflows because of the redemptions coming in. And with that, the valuations from a relative value perspective have collapsed. So US IG, Asia IG, they're literally on top of each other. So the argument that you had in the past where for the same rating, you could have a pickup by buying in Asia, that argument has gone away. And also it's become a lot harder to get your hands on paper in primary because it's collapsed. And in secondary, it's also not easy to do that because people are holding on onto what they've got. So there's been a push into, from a technical perspective, into the West. Now, the issuers that are engaging with that investor base, and obviously I was in Dubai yesterday with an issuer that has gone now 3 years in a row engaged in that conversation. We were in Asia with another issuer. They reap dividends because we had one example where a big investor said, of course I've heard of your name, it's a household name, but I've never looked at your balance sheet, and we as an institution don't have credit lines in place. We've never gone to the committee. And so your being here allows us to do that, which means that when you do come to the market, we can move very, very quickly. So it is a two-way process. And so the issuers that make the time, that engage, respond, answer those questions, they do get benefits. It's not necessarily overnight. It can be, but the rule of thumb is it takes a bit of time for people to know you. And that's very noticeable where the quality of the questions that get asked to the issuers, we go from the basic to suddenly over time actually on par with what European or US investors are asking. And then you realize that actually there is a following that is taking place. And when that happens, those orders can get big, they can get sizable, and it tends to be sticky, right? The Asian investors will come back. And so from our perspective, it's great to help that effort. The word has also gotten around the investor community in those regions that, if they spend the time, that they can participate, that they get allocation. And obviously issuers who engage, want to protect that, right? So it works both ways. But the other point to make is that even if the allocation into those new investors isn't necessarily made, either because, we view some of that money to be particularly fast or not slow enough, it does play an important role in the execution of a transaction where we go from IPTs to guidance. You maybe have a big book, it shows momentum, and then that allows the trade to then price even more aggressively, right? So there are many facets to this, but from our perspective, I've not seen an issuer who's dedicated the time not feel that was worth it.
Perfect.
If I just add to that, I think from a momentum perspective as well, I think Europe, where Patrick is saying, technicals have collapsed in Asia, and so Asia investors are looking to DM markets. Then it's a US versus Europe market, but Europe actually has a lot more tailwinds. Apart from the sort of uncertainty with the US in second half, you've got ECBs already cutting, you've got credit fundamentals actually in Europe are quite good. You're seeing corporate leverage is coming down from the peaks of a couple of years ago. You've got more options to play idiosyncratic trades in Europe versus US, because you've got sort of the Russia-Ukraine stuff, which creates some idiosyncratic opportunities. And then you've got the sort of banks versus sort of corporates, you've got the hybrids, you've got the AT1. So there's lots of opportunities in the capital structure, which doesn't necessarily play out in the US as well.
Thank you. Sorry, Atara, I have to say, we're running out of time. I do apologize for that, and I would have loved to open the questions up, but we are all available later on, so please do come and grab us. I would like to thank our panelists for a very, very engaging conversation. We could go on for another 40 minutes, but unfortunately we have to stop now. Thank you very much for your time. Appreciate it.
Thank you.